Gold starting off lower this week. We have Peter Hugg joining us for this edition of Pete's Sake to help us find out why. Peter, thanks for coming on today.
You're welcome, Alex.
So, Peter, did you get over the shock of the end of that game on Sunday?
I was in a hall with two other guys that were New England fans like I am, and the other 400 people were Seahawks fans, so I was extremely excited, but I had to walk out very quietly.
Smart move, Pete. All right, let's move to news this morning, starting with Greece and Germany. Some news there overnight. How do you see that moving markets?
Well, I mean, one of the reasons that we've been seeing, gold well bid over the past couple of weeks was a direct result of the Greek vote. Now, overnight, as we're speaking, Greece seems to be backing away from its aggressive stance, and they're trying to negotiate some type of package that would allow them to be less austere, but at the same time stay within the EU. Now, that'll depend on the Germans. So the Germans right now are waiting for the Greeks to make their proposal, and then they'll determine whether or not the proposal makes any sense. But the fact that they're talking and they're more conciliatory has taken a bit of the safe haven edge off the gold market and created some capital flows back into the euro and into the equity market. So that's why we're seeing a bit of weakness in the metals today.
And looking at gold prices, they were down for most of Monday, aside from that rally towards the end of the day. Today, down again. Do you see gold lacking bullish direction right now, maybe bullish news to power it forward?
Well, I think there's a lot of reasons to own gold. I mean, the global central banks, Australia just joined the gang today by dropping interest rates. There's a massive liquidity injection going on globally from everywhere. And, you have yields in some European countries that are negative yields. So, capital is looking for a place to generate yield. And with some of the issues that we've had, with Greece, some of the issues with the Ukraine that have recently resurfaced, obviously the Middle East, the geopolitical issues there, the stock markets have been sort of sideways and wavering and unsure of themselves. And that's created some capital reallocation out of the equity markets into the metals. Now, as things settle down, and I don't think they're settling down yet, but if they do settle down, some of that capital will deploy back from the gold market, since gold is a non-performing asset from a yield perspective, and find its way into a more risky type of investment, such as equities, where the upside will generate some yield.
Now, going back to last week, pre-Fed statement, you were on with Daniela and you said just focus on the language. The markets saw the language as hawkish. You didn't really see it that way. What did you make of the Fed meeting?
I mean, you had to listen to the whole statement. I mean, the first part of the statement could have been interpreted as hawkish. The Fed came out and said they were very pleased with the economy. It was growing, and employment was going up, and so it sounded hawkish. But they added something to their statement, and what they added was another caveat as to when and if they're going to move. And the original caveats being the employment rate and the inflation rate in the U.S., but they added now that they're also looking at the global situation. And when you look at Europe and the issues they're having with deflation, and you're looking at Japan, and you're looking at slower growth in China, the Fed has now given themselves an extra door to look at, and that's global situations. And in that context, that gives the Fed some cover to not raise rates this year. They may hold off those rates, until 2016, which is the camp we've been in for the past 6 months.
Focusing back on gold, we've seen, I guess, some kind of range-bound trading here between 1255 and the 1285 level. Do you see that gold range just holding up for the next little while?
Well, the 1255 range is the 200-day moving average. So from a technical perspective, that needs to hold. Otherwise, you're going to get computer selling and some fund selling if it breaks that 200-day moving average. So that's been the floor. It's held there well. It's bounced there 3 times. On the upside, the 1282 range, it's been having difficulty on the upside breaking through there. So that's still the range I'm trading, the 1255, 1285 range. I think a break through 1285 brings 1300 in, and a break of 1255, if that 200-day average is lost, moving average is lost, I would suspect that we might see gold then reassert the macro bear trend, which could take the initial move down into the 1220s.
Excellent. Thank you, Pete. Always a pleasure.
You're welcome.
And thank you for watching this edition of For Pete's Sake. As always, any comments or questions are always welcome at newsfeedback@kitco.com. Have a good one.